Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at OS Therapies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis of OS Therapies.
Yeah, let's do it. This is a classic biotech play, isn't it? High risk, high reward.
It is, but the data is just so compelling, we have to talk about it.
Okay, so here's where it gets really interesting for me. The stock is currently trading around, what, $2?
Yeah, about $1.90 to $2.10. But the average 12-month analyst price target is sitting around $17 to $18.
Wow, that implies an upside of over 800% if they can execute.
Exactly. So what drives that massive disconnect?
That's the question, right?
Well, what's fascinating here is that the market is still pricing in heavy risk. But the company's fundamentals, specifically the clinical data, they seem to tell a very different story.
And we're looking at a pre-commercial company, so the value is tied completely to the pipeline.
100%. It all comes down to the science and the regulatory path.
So let's start there. The lead asset, what is it?
The lead asset is called dasnelamgene-lisbac, or thankfully they just call it OST-HER2.
Okay.
And it targets HER2 expressing osteosarcoma.
Which is an ultra-orphan indication. So a very rare disease.
Extremely rare. And that means there's a huge unmet need. We're talking about patients where the disease has spread to the lungs.
Right. And at that point, there are virtually no approved adjuvant therapies once those pulmonary metastases recur.
None. The options are incredibly limited.
Okay, so what's the standout fact from their data? What's the headline?
The phase 2b trial results, they're really remarkable. OST-HER2 demonstrated a 2-year overall survival rate of 75%.
75%.
75. And that's compared to only 40% for historical controls in this same high-risk population.
That is an unusually strong efficacy signal. Regulators can't really ignore that kind of number.
They can't. It's a massive difference.
So what's their competitive moat here? This isn't just another cancer drug, right?
Correct. Their primary moat is their proprietary listeria-based cancer immunotherapy platform.
Right, the bacteria.
Yeah. They position themselves as the world leader in this specific modality, which creates really strong intellectual property. And, it gives them know-how advantages in manufacturing and immune modulation.
It's fascinating stuff.
It really is.
Okay, so let's unpack this regulatory path because that's the short-term driver. That's what could move the stock.
Absolutely. This is where the company could move from, a development stage cash burn story to a genuinely de-risked asset.
And management has framed the next 6 to 12 months as transformative.
They have. And they've already had a successful pre-MAA meeting with the UK's MHRA where they aligned on the key elements needed. So that's a big step.
And they have 2 critical meetings coming up in December.
2 huge ones. A UK MHRA pre-MAA meeting on December 8th and a US FDA Type C meeting on December 11th.
And these meetings will finalize their BLA strategy, their whole path to approval.
Exactly. And the targets for filing are very aggressive. We're talking a conditional MAA in the UK by January 2026.
And the EU.
An accelerated union MAA submission in the EU by February 28, 2026.
That's coming up fast.
It is. And what's really fascinating here is that the EMA, the European agency, is requesting an accelerated review.
They're asking for it.
They are asking for it. And on top of that, the FDA has already granted a BLA filing fee waiver.
These are massive signals. This suggests the regulators view this asset very favorably.
Huge signals. They're basically saying, we need this.
Okay, but we can't ignore the risk profile. We have to look at the other side.
Of course. And as a development stage company, they have no product revenue. So in Q3 2025, they reported a net operating loss of nearly $6.9 million.
And their cash runway is tight. They had $1.9 million in cash as of September 30, plus about $1.5 million after the quarter end. So that's around $3.4 million pro forma.
That's right. And that cash burn is significant. It's a real concern.
So this raises the primary worry for any investor here: financing risk.
It's the #1 bear case. They have secured some cash, about $7.8 million through warrant exercises, and they've established an ATM program.
The at-the-market program.
Right. But given the ongoing R&D and manufacturing needs, further equity raises are likely.
Which means dilution risk for current shareholders.
That's the trade-off. Simply Wall St. even notes the break-even point isn't forecasted until 2027.
So what does this all mean for bankruptcy risk? Is that on the table?
Well, the good news is the balance sheet shows a 0% debt-to-equity ratio. They are totally unlevered,
Okay, so they're funding primarily through equity.
which reduces that immediate bankruptcy risk, but it definitely heightens the dilution risk.
But there's a key mitigating factor, isn't there? Those strong regulatory signals we talked about in the EU.
Yes, that creates a potential path for non-dilutive capital. Think regional licensing or partnership deals before a U.S. launch.
Ah, so a big pharma partner could step in.
Exactly. That could inject a ton of cash and remove the financing overhang entirely.
Okay, let's look beyond the lead drug for a second. The broader platform. They aren't just a single asset company.
No, and that's important. The Listeria platform has significant optionality. First, they have OST 504 in phase 1B for castration-resistant prostate cancer.
Which is a much, much larger addressable market.
A huge market.
But the really interesting strategic move is the spin-off. Tell us about OS Animal Health.
This is a very smart move. They are spinning out the technology used for canine osteosarcoma.
Which already has conditional USDA approval.
Right, so it's a near-term revenue generator. They're spinning it out into OS Animal Health, or OSI.
And why do that?
It allows the human oncology business to stay focused and capital efficient while potentially monetizing the veterinary side separately.
And current shareholders get a piece of that.
That's the plan. They are expected to receive direct equity in OSA, which could unlock some hidden value that isn't currently reflected in the stock price.
So the investment thesis really is that these strong clinical data, coupled with this near-term regulatory momentum, outweighs the financing risk.
I think so, especially given the huge potential upside from what is a deeply depressed stock price right now.
This is a classic biotech call option on execution.
It is. At the current price, you're underwriting significant risk of dilution and regulatory delay, for sure.
But the potential reward.
The potential reward driven by that powerful 75% survival data is massive if they hit their BLA and MAA targets in early 2026.
So that's a great takeaway. For investors with a high-risk tolerance and maybe a multi-year horizon, this story has all the elements of a potential portfolio transformation.
Thank you for tuning into Smart Wealth with Joshua. Don't forget to hit that subscribe button to catch our next stock analysis.